Hi, welcome to the Elevate Market Chat. This episode was recorded June 18th of 2025. The S&P 500 stands within 2% of new all-time highs, and headlines continue to emerge. In this episode, Shane and I discuss the macro backdrop before getting into single stock selection and how to turn out the noise. Thanks for tuning in. Hey Shane, how's it going?
Kyle, I'm well, man. Just busy from running from one meeting to the next, trying to squeeze this thing in here with you today on June 18th, ahead of the holiday tomorrow. Markets are closed, so Elevate's offices are largely closed. Employees don't have to come to work, so I'm not planning to work too much tomorrow. What about you? You got anything going on tomorrow?
I think I will be working, so
Yeah.
I just got back. I had a short trip up to Minnesota, had a high school graduation to attend to, and yeah, been a little unplugged and just need to do some catching up.
Working on a federal holiday, man. You're putting some deposits in the account. I appreciate that.
Yep, working on that. So, but it's funny. I was telling you before this call, I have just kind of had my head in the sand, not really following the headlines. And now it seems we've shifted to possible war with Iran. Tariffs. I haven't heard anything about tariffs,
What's
but
tariffs?
the market's 2% away from all-time highs if you look at the S&P 500. And I was like, I don't know if I need to know the headlines right now because really maybe it's better to just be looking at the charts and those look, pretty favorable. So, what did I miss? Have you been seeing anything?
Yeah, well, I mean, I think you make a good point because if you tried to trade these headlines that were, that are coming in, you could post on social media and change everything in a heartbeat. So I don't know how people would really have much success trying to follow that. I mean, you'd have to have the headline ahead of time, and then you'd probably have to know exactly how the market would react to that headline, which is sometimes exactly the opposite way of that I would think. So these headline-driven markets are just they're exhausting, to be honest. And so I can't imagine trying to trade around all these headlines. I think technicals are absolutely the way to kind of light the path in times like these when fundamentals, certainly at the market level, don't make a ton of sense. I mean, if you looked at how expensive the stock market is compared to history, to its own history, and then looked at the geopolitical backdrop, you say, well, why would I be willing to pay more for stocks given how much uncertainty is exists in the market today, whether it's tariffs or geopolitical risk in the form of war in the Middle East. And as we've talked about, well, maybe not on this call, but Iran isn't a large supplier of oil to the free world, but it's a very large supplier of oil to this little country you might have heard of called China. And China might not really appreciate it if that source of oil gets turned off and the United States is involved offensively against that. So I mean, it could definitely trigger some type of domino effect. I'll tell you what, though, I am not a war correspondent or a military analyst. So don't listen to a word I have to say about any of that. It's pure speculation, and I haven't the slightest idea. No
Hmm.
idea. But to answer your question, yeah, plenty of headlines. Too many to recount, and certainly too many for me to try and trade around. Maybe if I had a little AI bot that knew exactly how to react to every headline, I could program it to do that for me. But that's also above my pay grade.
Yep. And I'm same as you. So when I zoom out, I'm just, okay, let's start with the indexes. So the S&P right now is up about 3% year to date. NASDAQ's up about 4%. Yeah, gold's been doing great. So that's one you can own when you have some of those headlines. That is up about 27%. And the good old Dow is unchanged for the year. So very different from how we started the year. Because I know, I had some phone calls and conversations, people talking about tariffs and the market had pulled back and hey, this is that next big move lower. And that has kind of gone by the wayside. But I was telling you before this call, what's interesting is I always go to this nice chart that I post for all the listeners. If you go to barchart.com, you can look and they've got all the different sectors, the S&P 500, and what percent of those stocks in that sector are above certain averages, key ones being like the 200-day moving average. And what was interesting is, in contrast to the last time we met, now I'm only seeing three sectors that are above those 200-day moving averages with any level of conviction. And what I mean by that is 50% or more of those holdings above. And that was energy, communication services, and tech. And I'm not drawing any conclusions from that, but just not seeing wide participation when we're about 2% from new all-time highs on the S&P just kind of made me scratch my head a little bit. Have you been looking at the internals? And by that, that can include, growth stocks, value stocks, any kind of theme playing out.
Not personally. No, I haven't. I've been so preoccupied with really just digging into what we already own. I mean, we're pretty much fully invested in our strategies. They've done very well. I could not be more pleased with where our strategies are year to date compared to the numbers you laid out, a minute ago. And so I just want to make sure that continues to go well because ultimately, like I really I don't know. I do enjoy more of the bottom up analysis than the top down analysis because I think, economics is interesting and the macro world is very interesting. I get all that, but it's such a complicated system that pretending like we can really know what's going to happen in the macro economy is just, I don't know, man. I look, if you could do that, economists would be the best traders in the world. And in my experience, that is exactly not true, you know. And to take it one step further, like the IQ level of a person is not directly positively correlated with their returns, right? If all it took was to be a really smart person in order to get really good returns in the market, then all the smartest people would be all the richest people, and that is demonstrably false as well. So I don't really pretend to be the smartest guy on the planet. I mean, hopefully I'm not an idiot, but I think the way that we add value for our clients and other advisors too is knowing how to control uh, eh, eh, to exercise at least some control over our emotions and not react to things that don't make sense to react to given all of the evidence. And so knowing how to risk manage, knowing why you own something, knowing what the actual like a reasonable intrinsic value estimate is for the things that you own, those are the ways that we are able to control our emotions. So digging into these companies, these absolute world-class businesses that we own, and knowing exactly when they drop to a point where it's like, hey, this is a very fair price for one of the best businesses in the world. You should buy some more. And just knowing when to do that, which companies those are, having a stable of businesses that you don't already own that you would love to own if they dropped to the right price and you have cash available, right? Because you can't add anything new to your portfolio if you don't have cash. So you got to have some cash in order to do that. Where does that cash come from? Usually comes from selling other things, either taking profits or selling them because they've fallen out of favor for whatever reason. So, um, I've really kind of dug in, I'd say, since the tariff threats were being lobbed around into what do we own? Why do we own it? What value do we want to own it at? What intrinsic value? Like what price do we want to pay for those shares? And I feel really good about where we are. And I mean, one company that just dropped below. There's a couple today that are dropping below our buy up to prices, but one that I would call out is Visa because it's kind of a timely and topical idea. Um, Visa is currently trading below my intrinsic value estimate. And so if I didn't already own some, I would be looking to maybe buy some. I don't know how much, or I'm not trying to give advice right now. So everybody's portfolio is a little bit different, but looking at the price per share, it's a price that I'd be willing to pay. Is the timing right? Will it go lower? I have no idea, and I'm not advising that you run out and buy a bunch of Visa, but there's a reason that Visa is dropping a bunch today, or over the past couple of days, and it has to do with the stable coin legislation that's going through Washington and I guess passed, I don't know, Genius Act or something like that. And so there's some concern out there that the whole banking system is undergoing a major shift towards cryptocurrencies. And we just talked on our team meeting about this at great length. And I have my doubts about how immediate and large the adjustments will be. I don't think Visa is going to go out of business tomorrow. So selling all your shares here because you're worried about some crypto, I don't think I think that's an emotional reaction, right? I think that's a headline driven reaction. And I think it's probably going to turn out to be the wrong reaction. Certainly time will tell, and I've been wrong plenty, and so maybe I'm wrong on this, but it's just a good example of number one, throwing a name out there that listeners can go check out. An example of controlling our emotions and how we identify how to allocate to value. So I have not been too focused on the macro. Um, but I will say this before I pass it back to you. The one thing that I'm really focused on at maybe the macro level, and I don't even know if you call it macro, but the tariff deadlines are rapidly approaching, right? So we're there's been no cancellation of the tariffs. There's been no rollback to 0% of the tariffs. They're paused for 90 days. The first date, for all the countries except China, um, that's July the 8th, I think. July the 8th or the 11th is when that 90-day period is over. And all countries except China will go from the currently imposed 10% tariff up to whatever the reciprocal tariff rate was announced on Liberation Day. So for Vietnam, I think that was like 45%, and plenty of other countries are up there higher than 10%. And then you've got the 90-day pause date on China's tariff. Well, that was actually for August. We'll see how that plays out. They apparently have a deal in place where China is going to pay 55% tariffs and we're going to pay 10% tariffs on their goods. But I don't know if that's a done deal. Do you know, Kyle? I don't know if that's like signed, sealed, and delivered, or if that's just like what has been advertised. Do you know?
I I'm kind of in the same boat as you. I have not followed it, closely enough to really know exactly when they expire, what gets set in stone. So it's a wait and see approach.
Yeah, I just remembered that they had that announcement after the talks that they had in like London or whatever. So I have to maybe check into that. Maybe the China deal is done. But at any rate, the China deal went from like 30% to 55%, even based on that new agreement. So I mean, if you're buying all of your cost of goods, the things that you ultimately sell to an American consumer, you buy them from China, your cost just went up 55%. Um, assuming that deal holds, which you never know. Trump and China have had trade wars before. It seems like every time they reached an agreement, something would change or somebody would say you broke the deal, and then things would ratchet back higher. So I don't know. Even if that was a final deal that they reached in London, um, whether it's been signed off on by Trump and Xi both, and it's in effect now, it could still always change tomorrow. So I think, but the other 90-day pause on all the other countries of the world except China is rapidly approaching, and Trump has said, multiple times that within the next 2 weeks he's going to just send a letter and tell them what the tariff rate is, and that is, I guess that if they're already at 10% and he needs to write them a letter to tell them what the new tariff rate is, I think you can be pretty sure that it's not going to go from 10 to 0 or 5. It's probably going to go from 10 to something higher. And so the cost of doing business is going up, even though it hasn't shown up in inflation, CPI yet. I assume that will. And I wrote a lot about this in my recent commentary. So if you haven't read the most recent commentary, which came out on Saturday, June 7th, I would point you to our website. Go check that out.
Hmm. So then with some of that headline noise, you talked about bottom up approach, which I think is a great way to look at the market. And that's where maybe this is kind of in the middle, but I was looking at the growth to value ratio. And what that is, for those who don't know, is essentially growth stocks, those who have most of their valuation based on their future outcomes versus, a value stock is one that's been kind of beaten down a little bit, usually a dividend paying stock. And right now, that ratio is the highest it's ever been, which essentially is saying most money has chased names like Meta, Tesla, tech names, all those who have a ton of value in their future income, not so much present day. Do you see that shifting, or how do you look at that? Because that's one where if I try and time what the overall market's going to do, I'm kind of just pushing aside all the pockets of the market. But there are names out there that have not had this historic run up, and maybe they're due, or at least maybe they have less downside. How are you interpreting that, and what are you kind of looking at?
Well, I would say that I really personally don't like the assignment of growth versus value stocks, the way that the financial media likes to assign things like, hey, you're either this or you're that. Um, so I start with that where like I'm hesitant to do that analysis, and I mean I look at I've seen those charts. Um, Most commonly when I review the JP Morgan Guide to the Markets every month when that comes out, which I'm trying to flip through the slides right now to find that one because they pretty much always have one in there as far as how is growth uh comparing to value. And I mean, just for everybody on the call, like if you don't know, they assume that things like, Coca-Cola and Procter and Gamble and Hershey are all value stocks, and then they assume things that are growing more quickly, like it's hard to say Tesla because they're not growing. Their valuation is growing, but their revenue is not. And their number of cars they sell is not. So like, but Tesla would be a growth stock, right? And Coca-Cola would be a value stock. Well, here's the funny thing is Tesla's not growing and Coca-Cola is like super expensive. So, and maybe not. Maybe Coca-Cola just dropped a little bit over the past couple of days to become more fairly valued. But point is, for me, growth is a component of value. So like when we look at a stock, we look at a business, not looking just at the stock. I'm looking at the business. What is this business? What makes this business great? Is this a brand that my great grandchildren will use? Like, will they use their products? Um, those are, and I don't know, obviously, right? But those are the kinds of exercises that we go through. And then we have to see what is the market implying about the current growth rate of that business, right? If the current valuation of a business doesn't imply any growth, I probably don't want to own that business. That's like the melting ice cube or the value trap, right? You don't really, it looks cheap because it's going to zero. Well, I don't want to buy it at $10 if it's ultimately going to zero. I only want to buy it at $10 if it's someday going to be worth more than $10. So I look at growth as a component of value. I don't really look at them as being at war with each other, or opposite things. I think, even a value stock, like if you went and looked at, I'll just use Coca-Cola as an example. If you went and looked at Coca-Cola, you're going to pay more for that business than the liquidation value, right? And liquidation value is if I just sell all the assets of this company, I sell all the current inventory, I sell all the factories, and to be fair, Coca-Cola doesn't do much of its own bottling, but if I sold all the office furniture that they have, if I sold the logo and the brand, right, which doesn't show up on the balance sheet, but if I sold everything they have, and then paid off everything they owed as far as all the debts go, right? All the money that they've borrowed along the way and so on. Bought all the shares back, paid off all the debts. I would have X amount of dollars. This is the liquidation value. Well, if you go look at, or even book value, right? But so if you go look at the stock, how many multiples of book value are you going to pay for something like Coca-Cola? Well, it's going to be more than one-time liquidation value, I promise. So why would you do that? Well, because the market is assuming on some basis a growth in revenue and profits. So even a value stock has some component of growth that the market is currently paying for. And so for me, I don't really pay attention to, hey, I want to have growth versus value. I just focus on I want to own world-class businesses. So I did find the chart value versus growth relative valuations in the JP Morgan Guide to the Markets. And right now, it still says value is cheap and growth is expensive compared to the long-term averages. That's gotten a value's gotten a little bit more expensive relative to growth stocks over, say, the past year or so. So some of these value stocks are kind of playing catch up. But right now, value is still cheaper than growth, which it's like to me, it's like, well, duh, shouldn't that always kind of be the case, right? But ultimately, for me, I don't put a lot of emphasis on that because like let's say value is cheaper and doing better. Well, I'm not going to go sell all of the companies that the market currently classifies as growth in our Elevate Capital strategy just to buy value stocks. Like I don't know. That's not the way that we manage money at Elevate. Doesn't mean it's irrelevant. You know, some people probably exploit that to the benefit of themselves and their clients, and that's great. But for us, we are looking for businesses that are absolute world-class businesses that, you know, they're not going to go up every year, but they're going to perform better than their peers in basically all market environments. So when, you know, when the market's good and the economy is strong, they're going to be up more than their peers. And when the economy is bad and lots of uncertainty is priced in, they're going to drop by less. And you know, from there, it's like, what type of environment are we in? We'll see. But if you're always holding world-class businesses with a good margin of safety and a reasonable exit strategy, we just do that, rinse, repeat, and the rest is kind of the noise kind of goes on in the background.
So that's kind of where the industry likes to form boxes and put the different types of stocks in these kind of style boxes. I think that's usually something you see, when you look at a stock in a Morningstar report, it has a style box, so it breaks it apart.
Oh
But at
yeah,
the end of the day,
I can't tell you how many times I've had a wholesaler, or as a wholesaler, I went into somebody's office and told them that the only free lunch in finance is diversification. You gotta cover all of your asset classes. It's the only free way. And it's like, yeah, well, cool. If you don't want to make any money, keep doing that. But if you want to make money, what you have to do is concentrate your bets on the things that are going to do the best. And, you know, you're going to win some and you're going to lose some. I'm not saying you can do that with 100% accuracy. Like that's not even like I don't know. That's like saying need to have a hundred or a you need to bat 1,000 in order to get into the Hall of Fame in baseball. No, you don't. Plenty of people get into the Hall of Fame as a hitter with hitting less, getting a hit less than half of the time they step up to the plate. Investing is the same way. It's your winners have to be big and your losers have to be small. You do not have to be right all the time. And I'll be honest, dude, that was a very difficult thing for me to get a real intimate understanding of when I started this because I hate being wrong. So if you tell me I chose a career where I'm going to be wrong, say 70% of the time, like I'm just going to spend my whole life mad about having been wrong. So it took me a while to get on board with the fact that like, look, being wrong 70% is like really good in this business. And so if you can do that and let your winners grow really, really big and hold on to them forever and never get shaken out of them because you know what you own and you know you're not gonna you're not gonna take your chips off the table just because it's up 100%. Like if you sold every stock that you had that was up 100%, you would never, ever, ever have a 10 bagger. You could never be up 1,000% if you sell everything once it's up 100%. And that's one of the biggest mistakes people make when they're trading their own money is they're like, oh man, this thing went up 100% in a year. I'm like, that's awesome. I'm going to sell it. And then, they log in 5 years later and they look and this thing has done nothing but go up. It's doubled three more times since then, and they left tons of money on the table. So, it's a hard pill to swallow, but we're wrong a lot. But we let our winners run, and when we're wrong, we lose a little bit of money. When we're right, we make a lot of money,
Hmm.
and that's the name of the game.
Yeah. And two things I take away from that is one, um, putting that style box aside, it's finding quality names that look good. So that it can be that simple. The other
Yeah,
thing is, you mentioned a 10 bagger, and something that doesn't always get put out there is that if you don't use risk management and you just bought a stock that costs $100, a 10 bagger means it has to reach $1,000. However, if you bought it at $100 and decided ahead of time, hey, I'm willing to take, let's say, a 20% loss, so $80, and then you would get out. Well, now you are only risking $20. It doesn't have to move up as much to make that $20 go 10x. So if you manage the risk and you have more of a concentrated position and go with, say, 20 stocks, you actually have the same risk profile, but now you can have a lot more upside and have a 10 bagger, 100 bagger. Um, who knows?
yeah. No, I mean diversification is also in some circles called diversification. I mean it's just the statistical analysis tells you that after your 20th stock, you're really probably not achieving any additional diversification of the systematic risk, right? Like if you have 20 non-correlated, or not highly correlated positions in different sectors and different areas of the market, like that's really it. And you can anybody can look this up. Just go look at over diversification on Investopedia or Google over diversification. You'll find the chart that I'm talking about, and maybe we can post it in the notes of this show so you could find it more easily. But I mean, there's a lot of different ways to do this, but that's kind of what I gravitate towards in what we do and the strategies that our core strategies that we manage at Elevate is like we're trying to put as much into the best businesses at fair prices as we can and just hold on forever. Um, we limit how much we can put into any one business by how much downside we're willing to accept. So, it's not like we're going to have all of our money in two or three stocks. That's not going to happen. But we also don't need 50. And we certainly don't need 500. And we certainly don't need every single stock in the market, through 1,000 mutual funds or ETFs. All you're going to get then is the market return minus a fee. And you certainly don't need an advisor to do that for you. If all you want is the market return minus a fee, just go buy VTI, the Vanguard Total Market Index, in your own Schwab account, and you'll get the whole market return, whatever that is, minus like a 4 basis point fee. If you're good with that, then that's what you should do. But we're trying to do a little bit better than that, and history has said that we can. So we can have less downside and more upside. So we can generate a better return with less volatility or downside risk. That to me is why people decide to work with Elevate. And
Hmm.
again, not guaranteeing that will happen on every single time frame all the time. I'm saying over the course of the history of this firm, even going back to when we were, advisors at another firm, this is what we've been able to do and why our business has grown. So no guarantees or promises about what we can do in the future, but that is certainly what we are trying to do, and sometimes we'll be more successful than others.
Yep. And the big one there is, outside of security selection and investment returns is just simply forming stellar financial plans. And that is the big part you are able to control. And, bringing that all together, and that's what we do here, is a powerful mix. So, um, I know we talked individual stocks and we're not macro guys, but Shane, 20 minutes from now, we do have the FOMC meeting. Jerome Powell's going to get up and speak. What are you doing to prep for this in terms of, what are you looking for? What would be the short synopsis for people listening?
Well, the first thing I did to prepare was went out and played a round of golf this morning, so that was lovely. Uh, I try to play at least one round of golf a week, and been trying to sneak that in on one weekday morning, instead of taking up the family time on the weekend. So that's been good. So that's how I prepared for this one. Really, the market isn't expecting much of a move today. Not expecting a change in the policy rate from the Fed. The futures market currently is pricing in or expecting uh, a 75% chance of one rate cut by September 17th. So that's, it's pretty benign. There's really no expectation that there will be a change in the policy rate today. So I don't expect a cut or a hike. I expect the Fed to come out and say, we don't know what's happening in the economy either. We don't know if the tariffs will cause an increase in prices. If it does cause an increase in prices, we don't know how long that increase will last. Will it be a temporary, one-time adjustment higher, or will it be persistent? Will it happen over the course of several months, or will it happen all at once? I think they don't have any idea, just like we don't have any idea. Certainly, if they're being honest, that's what they'll say is we don't know. They probably don't know, but we'll be asked about what war in the Middle East, if we decide to offensively attack Iran, what that will do to prices. And I assume they'll say, I don't know about that as well. I think since the last Fed meeting, also, Powell had a meeting with Trump in the White House, which was, reported, I think since the last time they met. So I assume he will be asked about how that meeting went as well. And my guess is he will not answer it. I think he'll say it went well, and that's it. We are committed to price stability and maximum employment, right? So I don't expect much out of today's Fed meeting. I don't expect the market to do a whole lot in response to it. The only wild card there is if they do adjust the policy rate one way or the other, and the market's not expecting that, then we will see some fireworks. So, again, if I'm a short-term trader, in my own personal account and my fund money trading account, I might look to capitalize on a little bit of short-term volatility as the Fed, releases their decision. But I mostly expect this to be a pretty calm one. So famous last words, right? Don't be surprised if it's like the least calm one we've had, but that's kind of my current expectation. And kind of no matter what they do or say, I know I keep harping on it, but going back to what I've said, for this entire discussion is like it's not going to change what Visa is going to do in the next 6 months, 12 months, 3 years, right? It's not going to change that business model. Um, if interest rates move a little bit higher, Visa's best in class. Maybe not the best. Maybe American Express is a little better, but they're a little different. They serve a different clientele, and if anything, it might give us an opportunity to buy some more of the businesses that we've been tracking, some of these world-class businesses that we've been tracking, at fair prices. So that's what I'm always looking for. If it gives me an opportunity to buy a world-class business at a fair price, I'm gonna take that opportunity with any cash that we have available to invest, which for most clients isn't much. We do have a few new portfolios that we're managing that we need to get allocated. So we're looking for any opportunity we can get to get invested. And if things should turn around and begin to go the other way, we've got our stops in place. We know where we're going to take profits off of certain positions, and so we'll take it as it comes. But yeah, and right when we started this call, I guess Trump was talking to media about Iran, and he said we've got a lot of intelligence on Iran, but he offered no further details on what that intelligence would be. So I think there's just another big wild card of uncertainty out there. We don't have a very good track record as a country of invading countries, and I mean, Iraq and Afghanistan and Libya and so on. It's like if we're gonna go do this, I hope and pray that there is a better plan than what we had for those other countries, which again, I'm not a military analyst or a war correspondent. I've never been to Iraq or Afghanistan or Libya, so I don't have any firsthand knowledge of how bad it is. But everything I've seen indicates that we didn't really leave any of those countries in a better place than we found them. In fact, maybe the opposite. And so I really pray that we I don't know. I I hope we can find a way to stay out of it, but my gut is telling me that we won't. And you know, I don't know. It does again, just on a personal level, it does scare me a little bit to think that, if Iran had a nuclear bomb, what would they do with it? Would they just sit on it and make threats with it, or would they actually use it? And if they actually used it, where would they use it? Because I don't think it's I don't think it's I don't think it's wrong to say that they don't like us very much. I think they would rather see the United States annihilated. So I get it. I'm not against it. Like there is a time for peace. There is a time for war. There is a time for all things. It says that in Ecclesiastes, I'm pretty sure. So I get that. I get that there's a time for that stuff, but I'd never like to see it happen.
Hmm. Yeah. And I'm in the same camp as you on that one. So we'll see. It's interesting. It always seems to hit during the summer, and then that's where volatility oftentimes enters. And um, yeah, we'll see what it or comes of it all. So,
Like you said,
but
2% from an all-time high, the market doesn't seem to care about any of these uncertainties or risks. The market just super, super complacent. I put a link to something Jamie Dimon had said, at a conference in my commentary as well. Where he's just like, it's one of the most complacent markets out there. It's too much complacency. And so we'll get another volatility shock and another drop, to well, it'll all happen. I don't, when will it all happen again? I don't know, but it will. Even if we're in a new bull market, like that stuff, every day is just one day closer to the next bear market, right? So doesn't mean you have to panic or go hide in cash or, just keep doing what we're doing. Buy world-class businesses at fair prices and hold them for as close to forever as you can. That's it. Just do that.
yep.
Everything will be fine.
So, well, Shane, I know you need to get going. You've got 15 minutes before the big meeting and pay attention, see what comes of it. But thanks for your time and look forward to catching up with you again here in about a month.
All right. Thanks, Kyle. Take care, buddy.
You too. Bye. Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.